In a world in which it's gotten very popular to be cynical, we discuss the importance as investors, if not as people, in distinguishing between being critical and critical thinking. The first thing that popped into my mind as I sat down to write this week's commentary was, well, that happened fast, didn't it? It was just about 6 weeks ago. We were in the throes of the tariff temper tantrum within markets, lots of volatility, lots of doomsayers coming out, telling you everything that was going to go wrong in the world. And so again, one of the points that we often try to point out to people, but I thought was a great time in this moment of adjustment for the markets to remind you of, is the important distinction between listening to someone who's just being critical and somebody who's actually engaged in critical thinking. And at times, it can be very difficult to tell the difference. 3 big points that I want you to take away from this week's commentary. Number one, being an investor is inherently an exercise in optimism. You need to believe the world is generally going to get better, earnings are going to get better. Otherwise, investing, particularly the stock market, probably is not the place for you. The good news is history has shown, again, that resilience of the market, that optimism usually is rewarded. Number two, distinguishing between those being critical as opposed to those really taking the time to engage in critical thinking. And lastly, that emotions are a largely unavoidable and rather big part of investing, if not life. And yet again, not something we want to listen to when it comes to guiding our investment decisions or our financial decisions. So again, first point, being critical versus critical thinking. They can sound the same. There's a lot of studies that have been done showing people gravitate to those who are being more critical. We all have that friend, that person we know who believes they're the smartest person in the room, is kind of skeptical and cynical about everything. Not really a recipe, generally speaking, for a lot of success as an investor. And again, just because you're definitive about something doesn't mean you're necessarily correct. How do you tell the difference? And really, what's behind that draw? Well, there's a great study done by Kruglanski, Webster, and Richter, where they looked at this phenomenon. And what they found is, for those people looking for closure, for certainty, which certainly defines most investors, sorry to tell you, not a lot of certainty when it comes to investors if you're looking for day-to-day movements, that people tend to gravitate toward more critical analysis because it is more definitive in nature. They tend to make emphatic statements or claims. None of that means, of course, that they're going to be right. Critical thinking, at least in my experience, is usually coupled with a fair amount of humility, an understanding that we don't definitively know what the future holds for us, and that just as many things might surprise us to the upside or in a positive way as, again, could stand to surprise us in a negative way. Let's take a look at point number two, the recent bear market, really what we learned from that. Again, after dropping to a 20% low from the highs, we've rebounded to a break-even rate, plus or minus, for the major indices year to date, all of which, again, happened at breakneck speed, which tends to have at least been our recent history with these bear markets. That both the descents and the rebounds happen in rapid order. And while we're talking about engaging in critical thinking as opposed to just being critical, that is not to say that we're just going to shut off our brains as investors and not pay attention. For those of you who are following our commentaries at the back half of the year, plenty of warnings around market valuations, likely volatility as we entered into 2025. But again, putting this all together is one, no one can ever know definitively. And two, whatever preparations you want to make need to be made in advance of volatility, not in the midst of the storm, when the quote-unquote fog of war is thickest, when emotions are running our highest. That's usually not the best time to be making big changes in one's allocation, unless one is prepped in advance, is now ready to, again, take advantage of those sell-offs as opposed to just have them take advantage of you. Related to all of this following of critical thought versus critical thinking is really the related point of following the mob and the mob mentality. Innately, you've undoubtedly heard this from an evolutionary standpoint, from a sociological standpoint, getting along with others, following the crowd, not standing out too much, has a safety mechanism to it in many respects. However, when it comes to investing, it's usually fraught with more peril. It leads to panic selling near a bottom, momentum chasing near the top of a market, all again of which is counterintuitive or backwards to buying low and selling high, which again we know to do as investors, but gets so tough when things get so loud. The other thing is the crowd is fickle. I believe that might even be a quote from Gladiator. But you look at the lows in April, markets plummeting, investor sentiment on the CNN Fear and Greed, a popular indicator, goes down into the low single digits. And here we are, just a few weeks later, the market's rebounded and we're already back up. Matt can share this graphic right now, to almost extreme levels of greed within the market. At best, going along with the crowd might be a coin flip in terms of its success rate. At worst, or more prudently implemented, you probably want to fade what the crowd's doing, i.e. do the opposite of what the masses are doing. And if they're getting greedy, as Buffett says, get a little fearful. If they're super fearful, that's the time to get a little greedy. To sum things up, challenges like the one we just went through in April are just going to be a part of the life of being an investor. But the good news is, for those who, again, can do a good job of tempering their emotions, sticking to a defined process, is the market usually rewards that kind of patience, that kind of discipline, and that kind of faith, again, in the resilience of markets in the economy. When you hear people being critical and you're having a hard time distinguishing what it might be, again, listen. How definitive are they? How certain are they of what they're saying? Or is there a little bit of humility rounded in? Is there a little bit to what they're promoting as an asset allocation that, again, has some hedges, has some safeguards to be ready for the next unexpected event? As always, if you need help with that process, if you're looking for that partner, we're here to help anytime. Thanks so much.